The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. And when we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors across the country with all their needs in life insurance, disability, long-term care, annuities, and life settlements for those that want to sell their policy. All policies have value, especially if you're older and it's gotten too expensive or you don't want it anymore, because life changes and it's a great asset to have, and you want to use it while you're living, not necessarily when you pass. So many people don't understand that is a great asset to have. So most people spend 30 or 40 years building their nest egg, and then they have no plan to actually use it. The biggest mistake is staying in growth mode when it's time to start generating income. So we've talked on our show many, many times about the fact that, hey, it's great while I'm working, I'm saving, I'm investing, but all of a sudden, when we don't have that salary coming in anymore, we don't really have a spending plan. There's no income plan. So our focus while we're working, usually ages 30 to 55, we're really focusing on accumulating assets, whether it's stocks or ETFs or real estate or a house or a business and reinvestment. And our goal is usually to maximize, our long-term goals. We have a much higher risk tolerance, meaning, you can afford to take some risks. You're going to take some hits, but hopefully the gains far outweigh the losses. So when we get to income mode, we focus more on cash flow and preservation. What do we use for cash flow and preservation is we have to really replace our paycheck. So there's many different ways that we do that. Well, one is Social Security, which we could talk about a little bit. The other is income producing assets. Maybe it's real estate that, you have renters coming in. Maybe it's bonds. And, the funny thing, we could talk about bonds a little bit. Bonds go up and down in price, but when the interest rate rises, the bond price goes down. They have an inverse effect. So right now, we're seeing interest rates rising and the value of those bonds going down. Now, if you're not selling them right away, it's okay to take advantage of a higher interest rate, but it's something you have to be careful of, because the higher the interest rate the bond is paying, it's probably the more risky it is. So when we look at, let's say, corporate bonds, they're borrowing at a much higher rate than, let's say, the government is spending, and the lower, they have gradings for bonds, A, B, C, D, whatever it is, the lower the grade of bond, and that's where the term junk bond came in, the more risky a bond can become. So a bond is really a loanership instrument that a company or a municipality puts out there as the first line of loaning, of putting out a loan and giving you interest income for that loan. So obviously, the more risky the loan, the higher rate they pay. Just like if your credit score is bad, you have to pay much higher interest rates on your mortgage. And that's how bonds work. So it's something you really have to be cognizant of. CDs, a lot of people will use as income. But again, CDs have a problem in that every year they're taxed. So that no matter what the growth is, and if you're using a lot of income from CDs, that money is being taxed every year, and it's hard to really accumulate. We like annuities. If you want guaranteed income, an annuity can give you a guaranteed income for as long as you live. And to cover your base essentials, annuities are a terrific vehicle. They can be a great vehicle for accumulating because there's no tax while you're accumulating. But as far as that distribution and income stage, you really can't beat the certainty and the lack of vulnerability to an annuity that can pay you an income the rest of your life. As a matter of fact, Social Security and the payment system is based on annuities, as are pensions. So annuities used to get a bad name for whatever reason. They got a bad rap. But really, they are the best income-generating assets that you know are going to be there for as long as you live or for whatever time zone you need the money. So there's a retirement red zone that I like to talk about. And this is the danger zone where the market losses hurt the most. We've seen that the last month. As we've gone to war and oil prices are shooting through the roof, there's a lot of market losses out there. And the sequence of returns and you getting back to the money you need for your income later, you really don't have time to recover. That's the problem. You take a big hit and you're taking out income, you're going to need that much bigger of an increase to generate that income in the future. So the biggest mistake, and this is where the shift begins, it's not at retirement, it's before retirement. The biggest mistake is saying 100% growth focused too long. You have to, even before you retire, when you're hitting 55, 60, think about, okay, let me shift how I diversify my assets. I can't be in growth mode forever because someone who retires at 65 that's fully invested, let's say, and the market drops 20%, you start withdrawing your income and your portfolio gets hit twice because you're drawing from less and less money. And that's how people run out of money. It's not bad returns, but bad timing. So you can't afford that. And we talk about how to create buckets. So how do you transition from this growth mode to this income mode? So one, you need different, what I call buckets. So one bucket would be your cash or your safe money. Usually you want 6 months of income, 6 months of expenses in your savings or checking account. You need income producing assets like bonds or annuities or dividends. And bucket 3 is your growth bucket. So all these different buckets you need to reallocate and continually evaluate. So you want income stability, continued growth, and emotional comfort. And while this is all going on, if you want to leave a legacy, you buy life insurance to complement everything you're doing. So I'm not saying get out of the market. As a matter of fact, you don't want to make radical decisions and jump everything out of the market at once. When you invest in the market, you dollar cost average in, and you want to dollar cost average out. So everything's done in a process. You want to cover your essential expenses again with Social Security, pensions, annuities, then invest the rest for growth. So make sure your bases are covered, and the rest you can still invest in some kind of growth. Retirement isn't about the highest return. It's about getting the right return at the right time with the least amount of stress. Again, it's not about the highest return. It's about getting a consistent return, making sure it's at the right time, and making sure you're withdrawing and have a spending plan, not just a savings plan, a spending plan that you can account for. So you're listening to the Main Street Code for Financial Success, or getting near the break. This is Neil Himmelstein. The best way to reach me is 631-647-4694. That's 631-647-4694. Or visit me at themainstreetcode.com. Thank you, and we'll be right back. Welcome back to the Main Street Code for Financial Success. Before the break, we were talking about switching from growth mode and accumulation mode to income mode. And a lot of us, part of our income mode that we're thinking is relying on Social Security. And we're going to talk a lot about that because Social Security is basically an annuity check. And there's a lot of seminars about when should I take my Social Security, and I get this asked all the time, when should I take? It all depends. It all depends. Everybody's situation is different. If you're in poor health and your life expectancy isn't very long, you may want to take it now. Okay, let's say you're 62, you may want to take it early. If you're still making a living and you're doing well, if you defer it, it grows by 8% every year, the amount you take out, and it may be beneficial for you to wait. If your spouse is sick, if you're sick, there's all kinds of different variables as when is the best. It's not a blanket answer is when is the best time to take out Social Security. It all depends. It depends on you. Everybody is different. One of the things that you need to know, if you don't know, the problem with Social Security today is that it was designed for a supplemental retirement for people, but we are living longer and longer. So the Social Security system depends on people putting money in when they're younger and when they're working, and then having this buffer for them when they retire. Well, it used to be we put in money for 30 years and we took it after 5 years and we passed away. Those numbers make sense. Now, we have less and less younger people and newborns in this country and immigrants and contributing, and more people taking out and for longer and longer. So under the current projections, we do have a reserve. Our reserve runs out in 2033 or a little bit before. Now, when I said this 2 years ago, 2033, so far in the future, right? 2033 is 7 years away. We're getting closer and closer. So do I think what will happen in 2033 if we continue on this path? Well, the Social Security system will go broke, which means they'll either have to take money from another pocket or go into a debtor situation, or they reduce the benefits. So either the younger people are going to have to start kicking in more money, which is a problem because there's less younger people, or they're going to have to pay us less or borrow more money to the deficit, which again is going to generate taxes. Now, if you look at today's Social Security, they may be giving you inflation adjustments every year and this and that. In no way is it keeping up with the actual inflation. I don't care what numbers the government's giving you. I know I'm paying more for my property taxes. I'm paying more for my homeowner's insurance. I'm certainly in this latest oil crisis paying a lot more for gas, a lot more for food, a lot more for everything. So if my Social Security goes up just a little bit and I was depending on that as my safe income, well, I don't feel so safe anymore if that was the only thing I was depending on. Come 2033, it's going to get drastically different. Now, the government has never adjusted for the fact that it's taxable once you hit $44,000, and that's with all income. So if you have other income coming in, whether it's from IRAs or you're still working and you're getting Social Security, that money that you've paid into is now taxed again. I mean, we could talk about if that's legit or not, but it is. And they've never adjusted that number. So even if they give you more money, they're going to take it back in taxes. It's a spiral here. So you need other assets and you need other planning. The main thing is you want to run into this income stream. You want to diversify your assets. And you don't flip a switch from growth to income. You really have to blend the two. You really have to figure out with a professional like myself, what am I doing for my income and what am I doing for my growth? And then how do I preserve and protect those assets for the next generation? All this is different than your stockbroker who's just trying to give you the best stock. We're not trying to say this stock's better than that stock. I can't tell you which stock is better than that. I don't even get involved in the market. What I do get involved in is looking at where the Treasury bond is going, because that affects interest rates, where the Fed's going, and the current crisis is where we're at, and how do we maximize where we're at today, not where we might be at in the future. So we can, with guaranteed income strategies, guarantee you income you can't outlive. We can protect income you can't outlive. We can protect it if you need long-term care. But all these things come into combination. It's not just, hey, what stock do I buy next? And when we get older, we're at retirement, you can't afford to have all your eggs in the stock market. You just can't. You need to have a steady income, and you need to preserve that so that just in case you live another 30 years or 40 years, where's that money coming from? You can't afford a big hit, so a big stock market hit, and then hope upon hope that it's going to come back. It takes a lot more to go uphill than it does going downhill. If you lost 10% this year, you need 12% just to get back to where you were next year. People don't realize that. I love mutual funds. They do a whole average by percentage of how they did the last 10 years. They're doing simple math. It is not simple math. If you had 10 and minus 8 and plus 5, oh man, they grew 10%. I've seen mutual funds that say they grew 10% over 10 years and they grew nothing because the losses are much worse than the gains. You need a lot more to gain so it's not a real number. Sorry, it's not. Now, you have to be cognizant of taxes as well. So if you're buying mutual funds, now your 401k, and while you're saving and you're putting in your 401k, you're putting in your IRA, you're putting in your Roth IRA, the wonderful thing about that is on all these vehicles, you're not paying taxes at the time. When you withdraw that money, not Roths, but IRAs, 401ks, pensions, it's all taxable. So you have to account for the taxes down the road as part of your income. So if all of a sudden, okay, I did the right thing, I put away a lot of money in my 401k and I'm taking out and I'm paying taxes, oh, guess what? And to supplement my income, I'm now on Social Security, I'm taking that. Okay, now that Social Security is taxable, the IRAs are taxable, the 401ks, what is my net income? You need to balance that out. This is why Roth IRAs have become so popular, and Roth 401ks are very popular for those who know what they're doing, because that money will come out tax-free. You're using after-tax money, you're not taking current tax deductions, but it comes out tax-free. And guess what? So does life insurance, 100% tax-free. So you put the money in after tax, you take it out tax-free. The beauty of life insurance, it has a tax-free death benefit. Now, if you do an annuity that pays you out an income for the rest of your life, it is tax-favored, not tax-free, but very much tax-favored and very tax-efficient. The older you are when you buy an annuity, the less tax you pay on it, because it pays out in principal and income, and you only pay tax on the growth of that income stretched out over a lifetime, which makes annuities a very efficient tax-favored income stream. You've been listening to the Main Street Code for Financial Success. Give me a call, 631-647-4694, or visit me at themainstreetcode.com. If you miss an episode, you can catch me on Spotify or Apple, and have a wonderful holiday weekend. Thank you.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.